Brad Williams, Frugal Finance, Wraparound Mortgage Loan. A clever way to get more funding for a property while keeping the current loan arrangement in place is through wraparound loans. The process is as follows. The wraparound lender makes a loan in an amount equal to the remaining loan balance on the existing loan plus the desired additional financing. In exchange, the borrower consents to manage payments on the wraparound loan exclusively, with the wraparound lender handling payment on the original loan. Here's an example to help you understand. Consider Smith, a homeowner who presently has a 15-year loan, 90 grand at 8% with $860 in monthly payment. Smith is interested in a 15-year, $30,000 second mortgage at 15.5% with a combined loan to value of 80% of the property value. Let's introduce the wraparound lender. The lender is willing to offer a $120,000 wraparound loan with a 10% interest rate in a 15-year term. They are not the same lender as the one holding Smith's current loan. Smith would pay $1,289 per month to repay this loan. Smith chose to proceed with this plan. He would keep making payments to the wraparound lender, who would then assume responsibility for Smith's present loan payments. As a result, Smith would pay $429 more each month than he did under the prior agreement. Taking current interest rates into account, a first mortgage with an 80% loan to value would have an effective interest rate of 11.5% over a 15-year period. Important to keep in mind, though, that Smith would only receive 30 grand in cash, the difference between the 120 wraparound loan and the 90,000 balance on Smith's current loan, because the wraparound lender takes on responsibility for the original loan payments. Would Smith be better off using a wraparound loan to obtain an additional 30 grand? Let's consider our options. The 120,000 wraparound loan has an interest rate of 10%, which is less than the market rate of 11.5% for a new mortgage of the same amount. Therefore, it seems like a wraparound loan would be a better option than refinancing with a new first mortgage. But why would the lender that wraps around offer a loan at a lower interest rate? What has this extra 30 grand really cost? Consider it as computing the additional cost of taking out a $30,000 loan. We must evaluate the additional borrowing costs associated with the 60% existing loan and the 80% wraparound loan in order to deconstruct it. The borrower must pay 10% interest on the full $120,000, not just the extra 30 grand, if they choose to use the wraparound loan for additional 30 grand. This stands in contrast to the current $90,000 loan, which has an interest rate of 8%. As such, the additional 30 grand represents an incremental cost that is greater than 10%. The true query then becomes whether this additional expense exceeds or is less than the 15.5% interest rate for a second mortgage with a total loan amount of 30 grand. In order to calculate the wraparound loan's incremental borrowing cost, we must determine the interest rate that strikes a balance between the extra funds received and the present value of the additional payments. Here is the existing loan, 90 grand. Payment, here's our simple payment formula. Rate, 8%. Term, 15. Property value, 150K. Loan to value, 60%. Refinancing first loan, 15-year, 80% loan to value. Second loan, 15-year, 15.5%. 120 grand. So 120 grand at 11.5% is 1401. Second loan, 30 grand is 430. 90 grand first plus 30 grand second is 1290. 120K first, 1401. Lender offers borrower a wraparound loan with the following terms. 120 grand, rate 10%, term 15 years, monthly payment $1,290. What is the mortgage payment on 30K? $430. Rate paid on cash out second mortgage 15.5%. Does the wraparound loan make sense? Borrower is netting 30 grand, or should lender just get a second loan? Either will work. Lower payment interest rate on the second, 112. So we discovered that the interest rate is 15.46. I guess I probably could go out and show you the 46, or approximately 15.5%, which is in line with what we would have anticipated for a second mortgage. The wraparound lender's choice to charge a lower rate on the wraparound loan is justified by the fact that the existing loan is already repaid at a below market rate, which allows them to still offer a competitive rate on the additional funds lent. The current loan rate of 8% and the second mortgage rate of 15.5% are weighted averages to create the 10% wraparound rate. So why, in comparison to a second mortgage, would the wraparound lender offer a better rate? Even though the wraparound loan still retains the original loan, it has one major benefit. The wrap lender pays off the first mortgage, keeping control over default risk. As opposed to this, the lender of a second mortgage might not be informed of a first mortgage default and might not be involved in the foreclosure procedures. Then, when a wraparound mortgage is set up this way, the lender agrees to pay the original mortgage only as much as the borrower pays. The wraparound lender is responsible for any defaults and tries to prevent foreclosure by paying down the first mortgage, foreclosing on it, or attempting to obtain the property's title instead of going through a foreclosure. The wraparound lender may agree to accept a marginally lower incremental return than a second mortgage rate as a result of this flexibility. Restrictions on the use of wraparound loans may exist in the original mortgage, such as due on sale clause or anti-further encumbrance clauses. On the other hand, the original lender may be amenable to discussions if there are no such limitations. For example, in exchange for the borrower taking out a second loan, they could offer a new first mortgage at the same 10% interest rate as the wraparound loan. This arrangement keeps the borrower as a client while enabling the original lender to earn a competitive return on the additional funds. In the end, the lender's readiness to adopt the wraparound rate shows that they are responsive to changes in the market. Essentially, they want to make a competitive return on the extra 30 grand they're not lending out. Brad Williams, Frugal Finance. Thanks for watching.